Broadcast is now starting. All attendees are in listen-only mode.
Hello, everyone. Good morning. Good afternoon. Not sure where you're at. Hopefully, everybody's doing well, staying inside and staying healthy, though. I want to thank you for joining me today. This is actually probably my favorite presentation to do ever. I think it's one of the most important that I do, and it's one that I've just seen thousands and thousands and thousands of times play out over. So really glad you could join me. This one. There's only one point where I'll ask you, to write something down. I will be recording this. I see some names that were with me last week on the webinar. That one was recorded. Unfortunately, the file was corrupt, so I'm going to be redoing that one here in a couple weeks. I think we're planned for April 16th. The other ones, although, if you've been on our other webinars this week, last week, they should be all in the archive session underneath our Education Center under webinars. So you can check those out. We unfortunately all have a lot of time where we're not able to do a lot else. So this is a great time. Take advantage of the opportunities. Been talking to a lot of friends. We can all sit around and watch TV, or we can actually take some time to do some good and all those things that we thought we would get done before. Now there's no excuses. All right, I'm going to get off my soapbox at that point. Well, at least until we start the slides here. All right, let's get started. I'm going to be taking questions at the end. Want to keep this very conversational, but please ask questions. Typically, I would save all of them for the end, but if there's one that pops up, I'm happy to address it at the time because it'll be relevant to those particular slides. So with that, before we begin, oh, by the way, real quick, can everybody see my screen and hear me all right? I'm understanding, since we're getting some hellos and highs here, that we're good to go, but just want to make sure. You should see most common trading pitfalls. By the way, a couple alternative titles for this webinar: how to trade for life. Notice it's not how to trade for a living, how to trade for life, or how to lose money trading. So let's get started, because this one's going to be a fun one. So before we begin, though, right, we always have to understand that trading anywhere, Nadex included, involves risk. You put money into an account, and hold on, it looks like one person's saying no audio. Everybody else came back with audio, Tom. It's not that you can hear me. You might need to adjust your speakers. Looks like we're getting good readings. Alrighty, so you can lose all your money on a trade at Nadex, right? If you put $50 up for a binary option and that goes against you, you can lose $50. Now, we are going to talk a little bit about how we take risk off the table when it starts going against us in this webinar, right? We all have to take responsibility for our trades. That's one of the things, I don't have it in my slide deck, but I'm going to talk a little bit about it, is just taking responsibility and knowing that those decisions are yours, and we can't place blame. That's how we grow and learn, is when we take accountability, right? And so with that, I think we've got enough time on the disclaimer. Today is going to be a pretty quick agenda. I'm going to tell you a little bit about me. This is about the only webinar where I really do more than just introduce myself. And the only reason I'm going to do this is because it's pertinent to the subjects that we're going to cover. Why should you even listen to me? Why are you going to spend your time here? Then we're going to get right into the pitfalls, and we're going to take questions at the end. So with that, let's get going. So a little bit about me. I've been around a while. I placed my first trade in 1997. Actually, it was my first order in 1997. I didn't really start trading until 2001. And I want to explain that because I opened up my first equities account in 97, placed an order. I was working for a tech firm. At the time, I was trading, not even trading, I was buying tech stocks, and I kept buying them, and the markets kept going up, and it was fantastic, and it was easy. And they kept going up, and I kept buying more, and they kept going up. Well, until about the spring of 2000, when they didn't anymore. And I received a very harsh market lesson and really realized I wasn't trading. I mean, I was baffled for a bit. I was actually kind of upset. I was like, why is this happening? Kind of confused. All the emotions that all of us of traders have probably gone through, many times. I was very fortunate, though, being here in Chicago. I had a lot of friends that were professional traders that went to the floor every day, and as good friends would, they beat me mercilessly with regard to what my practice was, but made me better overall. And they gave me a lot of good advice. And so when I talk about trading my experience, I went through, first 4 years, I went through blowups, and even until 2001, it was still difficult, right? I was just trying to break even. I was trying to, really figure all of this out and try to understand myself. And we're going to talk a bit about understanding ourselves during this as well. But I've been in this industry full time since 2004. Been really on all sides of the market. I'm a trader myself, a trading coach. I do education. I've done operations at brokerage firms as well as exchanges. I don't have any special education in this, meaning I didn't go get a master's degree on economic theory or financial markets. It's all been just real world, what I've seen. And that's what we're going to be talking about today. Where, consider it lucky or not, I've seen a lot of people succeed at trading. I've also had the opportunity to watch literally hundreds of thousands of traders fail. Now, I didn't know all of them personally, clearly, but working at a brokerage firm and being in the positions that I've been in and working with traders and analyzing, when you see somebody who's very successful, you can analyze what they're doing, how they're trading. You can talk to them. When you see people that are failing, you'll see the same patterns over and over and over again. And a lot of times it's like many things, it's more a matter of consistency. It's not rocket science. I think it was Ben Stein. I'm going to paraphrase him, not exactly quote him, but I think he said, nobody's too dumb to make money in the markets, but a lot of people are too smart. And I've seen that with trading. It's never a matter really of intelligence, but there's certain patterns and there's psychological patterns that people tend to repeat over and over again. So we really want to understand those and look at those patterns, right? It's how traders lose money. And I would guess if I asked the question, and I've done this at 100 presentations at least, live and online, why did people start trading? And invariably, the answer is to make money. And that's part of it, right? We all want to make money, but we have to understand we're going to lose money also. And the only successful traders I know are ones that know how to lose money better than other people. That's the one key difference. So that's what we're going to talk about today are these patterns. So let's get into the pitfalls. The first one, and a big one for me, is they don't have a trading plan. Now, this can be actually a hot topic debated around kind of even the professional education and trading circles on what a trading plan should be. It has to be personal to you, right? It should be something that's simple. It doesn't have to be, 9,000 pages. But the first thing I want you to understand, as we just mentioned, why are you trading, right? If your answer is to make money, and that's the answer 99.99% of the people I've ever asked that to have said is to make money, you're selling yourself short. I can't stress this enough. You have to be able to quantify what you want to do with that money, right? Is it take a vacation? Is it maybe you want to put a little nest egg away? Maybe you've got nieces, nephews, grandkids, or children of your own that you want to be able to build up a little stockpile for maybe their education fund, right? Maybe you're just looking for a little extra income. Maybe you want to trade for a living. That's what you want your full-time job to be. Maybe it's a house, whatever that is, write it down. That's the next thing that you have to really do is have that, excuse me, accidentally clicked, is put this in here, understand it, what it has to be. And the reason is you have to make it tangible, right? You know why Las Vegas uses chips, right? It's psychological. Chips don't mean anything to most people, right? They do have a value associated with it. At the end of the night, you can go, geez, I just lost $1,000, or geez, I just made $1,000. But actually, when you're sitting there playing with chips, it doesn't have the psychological barrier. And in a lot of cases, because we don't sit there and we don't think, wow, I've got $100 worth of chips on the table. That's actually a really nice evening out for my wife and I, right? We don't think about that. It doesn't associate, and that's why they use chips. If you understand why you're trading, you need to make these things tangible. Everything's online now, right? And sometimes I think and I've talked to people who do this, when they look at their trading account, it becomes very intangible. It has some relativity, but when you're just looking at digits on a screen, it almost seems like a video game. So in your plan, understand what it is, and this plan will evolve, right? You have to have a risk management plan. And this is so important. And we're going to get really into risk management here in a bit. But understand how much money you have in your account, what an acceptable loss on any given trade is, right? That's planning out a trade, but understand that before you're trading. By the way, don't start making up your plan when you're trading. Step away, right? Take some time, really give this thought, right? You need to have a plan for starting and stopping. And what I mean by that, and we'll talk when we get into taking money out, but when do you start trading and when do you stop trading? And I don't mean necessarily time of day, although that can go in your plan as well. I do know some people that are very successful that literally trade for 2 hours a day, and no matter what's happening, they get out. They might trade from 7 in the morning till 9 in the morning, and then they just stop trading. And everybody's different. That doesn't work for everybody. For them, in those cases, they might know through history that, hey, you know what, if I keep going, if I keep pushing, I end up giving it all back. So I'm just going to stop at 9. That's my 2 hour window. That's how long I can stay focused, right? So there's all different reasons on why you might set rules, but have a plan for starting and stopping your trading. If it's on a day-to-day basis, just as you have to have a risk management plan on, I can lose X on this trade. Well, how much is it if you lose X to stop trading that day, or maybe for a couple days? Or maybe you've made money, right? One of the big things isn't just losing money, but making money and trying to push and make more and more and more, right? Have a sensible time to stop. And maybe you say, okay, I'm going to lighten up positions. So one thing that it should be also, this has to be a written plan. I need to add that as a bullet point. I must have taken that out accidentally when I was redoing these slides, but it has to be written, okay? The reason it has to be written, it will hold so much more weight in your mind when you've actually taken the time to write it down. I would say this for anything in life. I'm a big proponent of goals, and I don't believe in just having mental goals. Um, you you need to write it down. It doesn't become real. It helps filter out all the nonsense in our lives when we understand what our plan is and where we're going. Again, this isn't just trading, right? We have all sorts of goals, right? We have personal goals, we have professional goals, we have goals for trading. Maybe we're learning an instrument. I personally started learning a new language about 6 months ago, so I have certain goals on where I want to be. Um, maybe it's an instrument. Maybe you want to play X song by X date, right? Write them down. There's so many statistics out there, you can look them up, about the difference between what's written and achieved versus what's not and achieved. Most things not written are never achieved. What this shouldn't be, though, this isn't exhaustive. Keep it simple. The first point up there, keep it fairly simple. Understand some key elements. The most important is, why are you trading in those goals, right? To make it tangible, your risk management and your plan for starting and stopping. There can be other things. When I say not exhaustive, so years ago, I was a trading coach, and I had a 12-week program. And the first program, we spent an hour just talking about trading plans. We did a template, and I I really requested people to, before the next week's module, to give me a draft of their plan. It didn't have to be complete. We just wanted to talk about it. And so this one guy, he ended up going through my course 4 times, I think 4 or 5, which was crazy. And I still didn't have his plan. And so finally, his last time through, he said, okay, I really need to see your plan. Otherwise, I'm not teaching you another module. And he's like, well, Dan, I haven't started trading yet. And I was like, okay, that's fine. You haven't started trading yet, but I don't understand what's going on here, because this is going to be one of the most important things. And as we build through these modules, I want you to, this has to be part of it. And so he didn't join another module for about 4 weeks. Finally, he sent me his plan, and he quite apparently missed the part about it being simple, because this plan was about 130 pages with every scenario imaginable. I mean, I started going through it, and it was so It was like reading, I don't know if anybody's ever read War and Peace. If you haven't, just keep in mind it's like whatever, a 2,000 page book. This plan couldn't be followed, right? Plan should be simple, right? There's so much to be said about simplicity. If you had a rule for every single market situation and you're trying to trade, first of all, that's impossible, right? We've seen that in the markets lately. But if you have a contingency for every single situation you can possibly fathom in the market, you'll never place a trade. If you do, and you're trying to flip through your plan to section 17B to see whatever is happening at that time, if you have a rule for it, right, that's not trading. So it's not exhaustive. I want you to keep these simple. And you can go out, you can do a quick search, find a template. I used to provide one, but I find actually if you just follow a few key things up there, you can write your own up. Really, if you really give it some thought, I'd say spend half an hour really thinking and digging. Spend more time if you like, but at a minimum, because this should be kind of involve some soul searching, right? So it shouldn't be exhaustive and it shouldn't be static. As traders, we're going to continue to grow. We're going to discover more about ourselves, more about the markets. We're going to continue to learn. Our goals are going to change. So if why are we trading was simply because we wanted to make another, say, $100 a week, perhaps we've accomplished that goal. Well, now maybe it's time to set another goal. Maybe that's still monetary. I would suggest not making it monetary. Hopefully I covered that well enough. I would consider making it, well, if you have that money, if it's monetary, it should go for something else. Perhaps it's an investment account. Perhaps it's, education fund for, somebody. Whatever that money is or that monetary value, it should have some meaning for a goal to be accomplished, not just the end result of more money. But again, it won't be static. You're going to continue to grow. Your risk might change. The risk management probably won't change a ton. At least it shouldn't, because there are some pretty hard and fast rules that have been proven out over the years. But a lot of different things in your plan may change. All right. Here's a big one. They don't plan every trade. I told you this was going to be conversational, so I'll just go on a couple tangents. Hopefully that's all right with everybody. Has anybody here ever seen the movie Ronin? Robert De Niro came out, I think, late 90s, I want to say. Well, that's okay if you have or haven't. I'm just going to go ahead and set it up. Basically, the opening scene, Robert De Niro is going to this restaurant to meet these other people. They're meeting up. They've got a job to do. Nobody knows what the job is. It's very covert, but everybody's told, go meet at this restaurant. Nobody's met each other before. He walks in the front door, mingling around. A couple minutes later, Natasha McElhone, this lady, comes in. She's leader of the group, comes in the back door and is like, all right, everybody come on, let's go. As they're walking out the back door from the restaurant, Robert De Niro reaches behind some boxes, pulls out a handgun. And they look at him and they're like, where'd that come from? And his comment, again, I'll paraphrase, was something to the tune of, I never walk into a room I don't know how to walk out of. Same thing is true for trading. Never get into a trade you don't know how you're going to get out of, right? Entering a trade is easy, but you need to know where the exits are. You need to know those before that trade is placed, right? You should always have at least a place where you're going to cut your absolute losses. Now, in the case of Nadex, this is a little bit different in some respects because you already have an automatic maximum boundary, right, that you can lose. Your risk is already defined and you already have a maximum profit target. That said, you don't have to hold on for the maximum loss. This is actually a big mistake I see with Nadex specifically, is that people say, well, I have a maximum loss. That's what I'm going to lose. First of all, don't say that's what you're going to lose. That's terrible for self-affirmation. Also, if the market proves you wrong, you can get out. So go into every trade having a thought where, okay, this is where I'm going to get out. This is where I believe the market's proved me wrong. If the market's moving in my favor, let's say it's to the upside, and I've seen this a lot too, particularly at Nadex, right? There's a maximum, every contract is capped. There's a maximum profit potential. You don't always have to hold out for the maximum profit potential. Let's say you bought, the one that drives me nuts, I'll just use this as an example. Somebody will buy a binary option at 30, right? So they put up $30, maximum return of $70. And the market will move up, and the market will keep moving up. And they'll be sitting there, and the market's sitting at, a 96 bid, no offer, right? And so they're sitting there, and maybe there's 2 hours till expiration. Now, if it's a minute to expiration, always understand where the market is. There's different reasons why you might want to hold it. But a couple hours before expiration, they're sitting there at 96. So basically, they've made $66 on their $30, trade, which is really good. Are they going to risk 66 for that additional 4, right? In some cases, it might make sense. In some cases, probability to say, yeah, let it go. Other times, though, it just doesn't. And so you really need to think about these things. And every trade is a bit different. I also think, if people are buying, what we call out of the money binary options, where if you're buying a binary at 15, this is another one. The probability of that hitting 100 or settling at 100, because again, binary options prices are probability based, right? That's what the market's perception of the probability of that event happening is, right? So the real probability is somewhere between the bid and offer. So if you're buying at 15, the real probability might be 13 or 14% that that's going to happen. But you don't have to have it hit 100, right? They're only all or nothing at expiration. If you buy something at 15 and it goes up to 40, that's pretty good return. You can take that profit. You don't have to hold them till expiration. So have some targets in mind. This is where I think it's very beneficial to trade multiple contracts. I actually had a mentor of mine tell me very early on, this was about 2004, 2003, 2004, somewhere in there, that he's never seen anybody make money trading one contract. Now, with Nadex, it may be a little bit different. He was talking about, at this time, we were both currency and futures traders. And the reason being, though, the same concept holds true for Nadex as well, is that let's say you're buying a contract at 15, right? Ideally, you'd love to see it go to 100, but the probability is very low that that'll happen. But you can actually set a limit order out if you're trading 2 contracts, right? Like I said before, you could close out at 40. Well, in that scenario, you can close one out at 40. And then you can let the other one see and run if you can get more profit, right? It's a very common trading strategy. Take partial profit, get to profit as quickly as possible, and then see the other contract run. And at that point, you're managing it. So at that point, if it goes from 40, maybe it goes up to 80, maybe it starts dropping back down to 70, maybe you say, okay, I'm going to close that one out. Whereas if you're just trading one contract, well, you got in at 15, you're closed at 40, right? Now, if you get in at 15, your maximum risk is 15, but you don't have to allow it to go to 0 either, right? Because if you get in at 15, and let's say you could close out at 10, the market starts moving against you, you could close out at 8, at 7, 5. Sometimes you might want to take those smaller losses. If it's at 15, it might not be as important, but if you buy at 50 or you buy at 70, right, and the market starts moving against you, if you're buying at 70 and you can only make 30 and the market starts moving against you, maybe you want to close out at 50. Just some thoughts and things to think about on every trade. You have to have a plan. Defined risk. So this is one, this was big when I was particularly in the currency markets and futures, where people would take on too much risk. For the leverage type market, right? Over leveraged, underfunded. Now, where I see it particularly apply to Nadex is that people will take on too much risk for their funding, right? So if you have, let's say, a rule, and most rules would say I don't risk more than 2% of any trade, 2% of my account on any trade. Some will say, okay, you can go up to 5%, depending on these other mechanics. We'll talk, a bit more on that. But understand what your account size is to what you're actually trading, what you're risking. Because if you have $100 in your account and you're risking 70 of it on one trade, you can't really last that long. If you have 1,000 in your account and you're risking 800 on any given trade, you're not going to last very long. Even if you get that first one, the next one probably won't. By the way, I also I know a lot of our members, and we have got a lot of people on here. I know that you're also trading other markets, so I want to keep these Nadex centric. So if I start talking about stops, which by the way we do have in development, when I start talking about stops and other things like that, I'm hoping to do it for the benefit of when people go and they're trading Nadex or they're trading Forex or they're trading futures, right? I want to make sure it's pretty broad based because this should be about all types of trading. So I had to stop. I had to stop. This is one I've heard so many times. This is one of the greatest things I think about Nadex. In the currency markets, in the futures markets, I don't know the numbers right now, but if you looked at the last 3 weeks, I would bet you've seen margin calls all over the place because the markets are moving so fast. Stops aren't being filled where they should. People are taking on too much risk for the volatility, not understanding the markets, and they're losing a lot more. And it comes down to, well, that can't happen to me. I had to stop there, right? This also goes to taking responsibility, right? We might see the perfect setup. Again, if we've got $1,000 in our account, Nadex or elsewhere, and we're risking 800, or maybe we're only risking 500, but we haven't defined what that is. Oh, it can't happen to me, so it's not defined. With Nadex, we always have that defined risk, but it's still up to you as a trader to understand that, look, here's what I'm risking on any given thing. A trade can go against me, even if it looks perfect. It's the perfect setup. Oh, I bought it at 95. It can't possibly go to zero. Well, it can, right? Understand those things. The great thing about Nadex, I don't think I finished that, was we haven't had any margin calls. It's actually not possible at Nadex. So in markets like these, I'm very proud of what it is we do in that respect. So they trade stupid. There's a lot of ways to trade stupid, and keep in mind, I've done all of these at one time or another. I still do at one time or another. For the most part, I've knocked them out of my trading regimen. But understanding position size to funding, the tick value of their markets, these with Nadex are pretty easy to understand, right? Your position size to funding, knowing your risk up front. Again, it goes back to that. You know, don't throw everything at one trade. Understand where you're at in the market. If you're starting out with a smaller account, trade smaller. We have very flexible contract sizes. Trade smaller. You can always scale up. The markets are going to be there. They're not going anywhere. So you have lots of time to learn. Start slow and grow. The over trading. This is the one that I think I see most pertains to a lot of people in all markets. But I think when I see people get in and they've opened up their account and they're ready to get going and there's excitement, there's a thrill and bells are going off and the markets are ticking and it's wow. It's like, okay, I got to place trades. I'm a trader. I'm going to place trades. I've got to trade. I've got to trade. That's what I do. I'm a trader. That's not the case. I'm going to give you a few words that a friend of mine gave me a long time ago. Cash is a position. Okay, I'm going to repeat that. Cash is a position. Just because you have money in your account doesn't mean you need to be trading every second of the day, even every session. You have to be patient, right? This is such a key thing. If you're just trying to bang away just for the sake of placing trades, you're going to lose money, all right? You don't have to hop around. You don't have to be all like, oh, this market, that market. Hey, I'm trading, right? Don't overtrade your account. And you'll know if you are because we'll get to this last point in a second, but it does lead when you're over trading, it almost invariably leads to chasing losses, right? All of a sudden you start losing money and then you trade more, you upsize, and it's revenge trading and you're going to beat the market. By the way, that's a phrase I hate. Just from a psychological perspective, I'm going to beat the market. Well, you know what? Nobody ever beats the market. The market's beaten a lot of people and beaten badly. Even Warren Buffett has never beaten the market. What he's done, though, is learned how to work with the market. This might be one of the things, and there's been a lot of studies done on this, and I've worked with a lot of couples as a trading coach, and it was awesome. I heard some just fantastic discussions. But I will say, and I can't remember, there was a large firm that I think a couple of them that have done the studies that on average, women are typically better traders than men. And I've read a lot of the psychology behind that, and I've witnessed it in my own experience working with these. And it's not a blanket statement, and this isn't to I'm a guy here, so guys, don't get mad at me. Just reporting the statistics as they're known. And one of the reasons is often the guy's ego. We want to beat the market. We don't want to go with it. It's a challenge for us. It's a competition. Now, don't get me wrong. I've seen women with the same attitude. I actually, one of my great friends was in the ES pit a long time ago, and she was quite the firecracker. But revenge trading and trying to beat things. When we're talking about this, and a lot of these things just go back to psychology and how we approach it, and what we're thinking to ourselves, right? We're getting aggressive. We took some losses. Somebody's got to pay. Don't get into that trap. Don't get into that trap, right? These all come to a lot of times thinking it should be exciting. Um, I um I actually like to share a lot of things my mentors told me that I think are really relevant. So if I keep saying my mentor, it's been a lot of them over the years. I'm just going to leave them all as one anonymous my mentor. One of the things said to me, I was actually talking to a group of us at the time. Somebody had made the comment to him, well, wow, you're a professional trader. You must have the most exciting job in the world. And this particular guy didn't really mince words, and I won't requote exactly how he said it because my compliance department would never let me do another webinar again if I use that kind of language. But he basically looked at him and said, that's the dumbest thing I've ever heard. If you think trading is exciting, you're doing it wrong. If your heart is racing and your palms are sweating and you're on the edge of your seat, you're absolutely trading wrong. It can be fun. Don't get me wrong, it can be very fun. Even when you're losing money, it can still be fun, right? And why can it be fun if you're losing money? Because you know that that's part of it, because you know that this is an opportunity to learn something. There's a lot of reasons it can be fun when you're losing money. When you're losing a little bit of money, but you know and you have that planned out and you're willing to accept those losses, it doesn't get in your head, right? It's when you're taking those big losses and overtrading and it's exciting. That's when it gets in your head. So if you're on the edge of your seat trading, take a step away. It should be methodical. You should have a method for how you're placing your trades and your risk. All of these things kind of come back to the same point in a lot of cases. This is one I love. Traders want to be right. Oh my God, the number of people I've talked to at trade shows, at that I see online, from personal experience, that will come up to me and they'll be like, "Oh, I have a system that works 94% of the time." I don't care. We'll talk more about those numbers, but it's the same thing. They want to be right. The conversations I've had with people where I'll call them up and I'll just say, "Hey, Joe," and let's say I looked at this guy's account, and this particularly goes back to my broker's days. I look at this guy's account and I say, Joe had $10,000 in his account, and Joe's now down to $6,000 in about a week. I'll call up Joe and I'll say, "Hey, Joe, how's it going, man?" Invariably, the response is like, "Oh, it's great. It's just awesome. I'm right like 70% of the time. I've just got to make a couple tweaks." No, Joe, you're bleeding cash, right? See, that's the misperception is that, and we'll get into the ratios here in just a bit, but that's just not the right way to trade. It's not about being right or wrong. It's about being profitable overall. Kind of a funny story here on the you're wrong and that's bad. So, um, one of my previous jobs, I was a market analyst. To me, that was still I love what I do, and I go to work happy every day. But from just an absolute fun, I've always had a passion for the markets since as long as I can remember. But I used to sit in my office and I'd talk to reporters, I'd do some TV spots, and but mostly I just sat there and I analyzed all different markets all day and I traded. So I'd sit there and when I was about to place a trade, I would call out the trade to the office to whoever wanted to take it. And so this guy was sitting not too far from me this one particular day, and I just remember this vividly. I called out this trade. It was I was like Euro USD, 3 lots short, 126.70, 35 pip stop. This is stuck in my head to this day, and thousands of trades later. But for some reason, this one stuck in, and I think because of what I'm about to tell you. So all of a sudden, I hear a yell back. He's like, "I'm in." And I was like, "Okay." So as a lot of my trades would happen, I wasn't expecting a long-term trade. I was expecting, maybe something for half an hour, couple hours intraday trade. Well, I got into this market rallied against my short. I was stopped out in about 30, 45 seconds. That happens. So I just kind of shook my head, grabbed my coffee cup to go to the kitchen to get more coffee, looked at him, and I was like, hey, that'll happen. And he's like, oh, I'm still in the trade. And I was like, really? You're still in the trade? Like, where's your stop? And he's like, oh, I have a mental stop. And I was like, oh, well, where's your mental stop? And he was like, oh, well, I'm going to see how the market. And I was like, I just walked away because I was like, okay, he's going to lose more than he ever should have on this trade. So first mistake there, right? He's just letting it run. He wanted to be right, and he wasn't right yet. I walk in. It's like 3 days later. I walk in and talking to him, and I see his screen's up, and he's still in that trade. Now it's 3 days later, and I was like, "What are you doing?" The market's moved like 200 pips against him, right? He's down big. He's down like $6,000 on a $20,000 account, something like that, $22,000 account. I'm like, "What are you doing? Why are you still in that?" And he's like, "Oh, well, it was a swing trade." Which doesn't make any sense. So there's kind of a joke in the industry, and I know a lot of great swing traders. One tip here, the market will always determine if it's a swing trade. You can't. Swing traders are only swing traders because they're good at managing positions. But typically, then the joke in the market is a swing trade is just a short-term trade that's gone bad. And I've seen it too many times. You just hold on to it. It's going against you. I see people do this on the short term too, though, right? The market's going against them. Goes back to what we were talking about earlier. Market's going against them, but they want to be right. And so they don't ever take that smaller loss and they let it go to zero, right? Don't do that. Always be willing to cut your losses quicker than the maximum loss. So anyway, back to my friend here. So he's now had a short-term trade with a mental stop that's become a swing trade. So about 2 weeks later, he's still in this trade. It continues to go against him. And I'm like, what are you doing? I mean, at this point, he's down. I think it was like $18,000. So I think he was in the trade for a total of about 5 weeks. So it's about the third week when I'm looking at him. I'm like, what are you doing? I'm like, why are you still in that trade? He's like, oh, it's just a punt. He couldn't admit to himself, one, that he was just wrong. So he had to take the responsibility off himself and say, oh, it was just a punt. I was just messing around. Well, if you've got a $22,000 account, $18,000 of losses are not just messing around. I mean, the guy wasn't hurting for money at all, but still, nobody does that. And so the funny thing about this, so he gets to within about 20 ticks of where he's going to get a margin call. He was down, I think, what was it? He must have had about 25,000, I guess, in the account because he was about $18,000 losses, and I guess we had about 100 to 1, so he was about 3,600. Yeah, it was a $22,000 account. He was about 3,600 in margin. He's about 20 ticks away from getting a margin call. Basically, his position closed for the loss, right? He wasn't actually going to get a call because he still had funds securing him. Anyway, market starts to drop, market starts to drop, market starts to drop. His $18,000 loss becomes 15, 12, whatever. Finally, after about a week and a half, the market recovers, drops to just below where we went short, 127.60. It hit like 127.50. And he closed out his position for a 10-tick profit on each contract and couldn't wait to tell me how he knew he was going to be right. If that's how you're trading, if you want to be right, he had such a desire to be right. Maybe the trading gods blessed him with that. I doubt it though, because they don't like that type of trading. But just unbelievable that somebody would hold on a position like that and risk. But psychologically, people want to be right. It's never about being right. It's about being profitable. And to do that, you've got to understand the key ratios, right? This is the first one that everybody will tout. How many trades did I place? How many did I make money? How many did I lose money? Oh, I'm right 70% of the time. No, right? And that's why I don't have right, wrong here. It's profitable and lost money, right? There's another key component you need to know to this, right? And scrutinize people when you see these websites or whatever that say, oh, our system is right 75% of the time, right? Well, what's your average profit and average loss? And actually, I'd even add one to this. what's your maximum drawdown? I don't even care about maximum profit, but what's your maximum drawdown? Meaning, at any given time, how much did you take in losses before the numbers came back around and you were profitable, right? If you're looking at a website or any type of system. But for your own trading, take your total trades, right? Some of the best traders I know, by the way, make money on 15, 20% of their trades. That's it. They're just really good at managing trades, and they're really good at taking losses off quick, right? But then take your total trades and take your average profit and loss, right? So if you're 50-50 on your trades, right? Just 50-50. 50% were profitable, 50% lost money. If your average profit is higher than your average loss, in this scenario, you're making money. If your average profit is lower than your average loss, then you're losing money. Very simple. We're going to show how to track trades, but understand these key ratios, because the total trades, the average profit, average loss, the risk-reward ratio post-trade is actually a thing a lot of people miss. They're only looking at, going back to that Joe that I was talking to that, was down $4,000 in his account and was like, hey, everything's great. Yeah, he didn't understand these key ratios because he was taking a lot bigger losses than he was on profits. Yep, want to reiterate, I think I mentioned it, but this should be post-trade, right? A lot of people say, oh, well, I set up a 2-to-1 risk ratio in all of my trades, right, as I get into them. Well, that's fine, but it doesn't matter. All that matters is what happens in real life, not what we hoped was going to happen. All right, this is a big one. They think strategy is the key. I remember when I first got going, and I thought, wow, if I only knew what the pros were doing, what indicators they're using, what strategies, what time frames, I could do this. I could be profitable. You know what? I wouldn't have been. Not using somebody else's. Strategy is important, but it's not the key. Risk management is absolutely the key. You do have to have a strategy. When we talk about tracking your trades, we'll get deeper into this. You do have to have a strategy, right? You want to have something you can do consistently. But all of that is hogwash without money management. The best strategy in the world will fail without good risk management and money management, right? So one of the number one questions we get from people wanting to learn to trade Nadex, and I've seen this across every market, future side, currencies, Nadex. I bet people trading stocks, I've heard it from them. The first thing they want to know is what's a good strategy, and that's like the last thing they should really be worried about, right? They need to have one, but don't do that first. Understand risk management, understand those principles, and set that up in your trading plan, right? There was actually a study done, and to illustrate this, I don't want to run too far over here, so I'll try to make this story short. I told you I'd go off on tangents here. There was a study done back in, I want to say around 2006, published in a magazine, where they took 2 professional traders that had been trading, it was like 10 plus years, had been consistently profitable year over year over year. 2 professionals took 2 newer traders that had been trading for a little bit, say 6 months to a year, had mixed results. They weren't just somebody that was green off the street. But anyway, they mixed these 2 as pairs. They took 1 pro and 1 amateur, 1 pro and 1 amateur. They made them teams. They gave them 1 asset. It was the Euro USD, I believe the study was done, Euro USD or pound dollar. 1 asset to trade for a full month. Team A could only be long. Team B could only be short, right? So you'd think, well, one team, if the market's trending up, is clearly going to make money, and one team, if the market's trending, the other team, if the market's trending down, is going to make money. If it's in a whipsaw, who knows, right? The market actually that particular month was somewhat in an uptrend. Overall, it was in a pretty solid uptrend. However, what they found at the end of the 30 days was that both pros, right? One could only be long, one could only be short. Both pros had made money. Both of the newer traders had lost money. They were trading the same instrument, trading basically the same direction. What they found was it had nothing to do with strategy. But when they analyzed all the trades, the professionals had better risk management. The one professional that was only trading short in an uptrend was getting out of his losers very quickly, but he was trading trading retracements, looking for key levels. So it was all about the risk management and not about the strategy that was important. So we will talk a little bit about strategy now when we get into consistency. Pinballing all over the place, jump from one strategy or market to the next. I don't know if anybody's screens ever looked like that, where they just have indicators all over the place. I've had people where I've done screen share with them that I've looked at their screen and it looks like I don't know what it looks like. It looks like every technical indicator ever just exploded on there. So once you have your idea of risk management down and how you're going to implement that, then you want to look to a strategy. What you want from a strategy is something that can be done consistently. Consistency is such a big part of trading. I don't know if anybody on here has ever ever traded or started to learn options. I love options. I think they're great. I mean, all Nadex contracts are options basically simplified. But if you hear some of these, and I'll throw up the air quotes when I say gurus, some of these options gurus, and you start talking to them, and options can be difficult enough. They can be a lifelong study, just like trading in general. But you get into options and you learn, oh yeah, I can buy a call. I'm calling the market up. I'm putting the market down. Got it. Then you start to learn the Greeks. Oh, hey, I've got gamma. I've got theta. I've got to learn these. Okay. And then somebody starts throwing out these crazy, wild option strategies. I've got a triple long inverse iron static condor. Whatever. That's not a real option. Well, maybe it is. I don't know. There's thousands of them out there. Right? The best options traders I know, just like the best traders I know, what they do is very simple. It's not complicated. They have very simple strategies that they can repeat over and over and over again. That's probably one of the biggest keys to trading, right? Work with your strategy. So often strategies, and there's thousands of them out there, come down to risk management, right? And sometimes a strategy will get credit. A couple weeks ago, it's actually in the archive if you want to check it out. I walked through one of the methods or strategies I use and have used for years in the markets because it can be replicated. If you look at any like professional athlete, you look at a professional golfer, for instance, and they walk up to the tee, they'll typically have the same approach. They'll probably pick out their spot, where they want the ball to land. They'll visualize that. They'll shuffle, get to their ball. Maybe they'll waggle the club a few times, and then they take their swing. They do it over and over and over again. It gets them in the right mindset. Consistency and strategy and understanding that is very important, but also just consistency in life, right? One guy that I used to trade with, he'd been trading about 30 years when I was kind of new. He was a great mentor of mine. But literally every morning, he was a professional trader. This was his job. He would get up, he would have a cup of coffee. He lived along the beach in California. He would take 1 mile, he would walk 1 mile down and 1 mile back up the beach, take a shower, and then he'd be ready to go in front of his platform. And that was how he got himself mentally ready to trade. He didn't just plop down half tired, and if he wasn't feeling well, if he wasn't just mentally into it that day, he just walked away. The markets will be there. Some days we just walk away. When we're there, though, we want to be as consistent as possible. Because you know what? If we're consistently taking losses, then we know we need to stop trading and walk away. Right? If we're making money, then we can continue going. All right. If everybody here wants to learn how to be a better trader, this is the only part you'll want to write down. You don't even have to write it down. You'll probably memorize it because it's very simple. The tracking of trades, super important. Now, for a long time, people did this via Excel or other documents. Some people really love Excel. I just personally spend way too much time in it, and I'm a technical trader and have been for years. So everything for me is visual. So I believe it's very important to track your trades. Now, nobody wants to sit there and trade and then also be keeping a spreadsheet. I mean, some people do, believe it or not. Some people do. And if you do, that's fine. But tracking of trades. This is going to be the simplest thing that can change your trading life, right? You have to put it into practice, just like everything else. Knowing what to do and doing what you should are two different things. So here's a way to be a better trader. 3 magic keys and $10. They're not actually magic keys. They're very easy. But on your keyboard, you'll see Control Alt. Oh, and by the way, you can practice this right now if you like when I get to the end of the slide. If you hold down Control Alt, now I don't know what it is. This is for Windows. I'm not sure what it is for Apple. So you might have to look that up. But if you hold down Control Alt and print screen, your button, depending on your keyboard, might say something like PRT SCR. But if you hold down those 3 buttons, it takes a snapshot of your screen. So if you want to try it out now, you can. These 3 buttons take a snapshot of your screen. So if you're looking at a chart, right, and you're working in a strategy, what I recommend everybody do is take a screenshot. So what that'll show you is it'll give you really all of the information you need, right? It'll tell you where you entered. You can annotate all the charts if you want to. You can, you've got whatever indicators you're using. If you're looking at patterns, you have a screenshot there. I encourage you to take a screenshot at the start and at the end of every trade, right? And you can file them however you want. And so what you're also going to need, if you don't have a printer, this might be a little bit more of an expensive proposition, but you can order printers pretty cheap now. Well, actually, you know what? I was going to say, I typically say go to the office supply store, but now if you feel more comfortable, I would say just order it, have it delivered to your door. But for $10, you can get a ream of paper, a 3-hole punch, and a binder, right? Do this. If you need a printer, get one of those too. It'll be so worth it. But when you take a screenshot, drop that screenshot into something like PowerPoint or a Word document and then print it out. It has to be printed out, right? Because you'll never go back to if it's in a file, right? But if you can print it out, you can go back and learn, right? When you take losses, what do you do with those losses? How much time do you get to spend learning them? Or are you just on to the next trade? I should say learning from them, right? I was talking to, this helped me out amazingly in 2006. I did a big analysis on these patterns I was trading. And you can file these however you want. You can file them by market, by strategy if you have different strategies. You can file them by losses. I actually, for mine, I filed them by strategy or by pattern I was trading. And then for my losses, I had red tabs, just so I could pull those out quickly. I was down giving a presentation in Fort Worth a couple years ago to a big group and talked to this guy real quick on him. He had always dreamed of trading, never really found the time. He had his full-time job, and he worked, I believe it was in a warehouse, hurt his back, couldn't continue working. He was laid up for like 6 months. So he thought, well, this is the perfect time for me to learn how to trade. So his wife actually took $10,000 out of her 401k as a loan, opened up his trading account, and actually for the first 5 or 6 months, he did pretty well. And then all of a sudden he started losing money, and he couldn't figure it out. And so he was like, okay, well, he'd been tracking his trades. That's one thing that he'd done all along. He kept a screenshot of every trade as it progressed. And so he was kind of up and around, still homebound, started losing money, getting close to going back to work. But what he was able to do was on his dining room table, he took all of his losing trades, and he was using pretty much the same strategy. He just took all of his losing trades and he just laid them out on the table like a big puzzle, and he just studied them, and looked at them. And in his words, all of a sudden he said, Dan, there was just that moment where it all clicked, where there was this thing that I was doing that when I looked at these losses, I could have cut half of those losses so easily and should have cut them earlier. If he hadn't tracked his trades, he'd have probably not been able to do that. Now, one thing he did very sensibly in addition to tracking his trades was when he started taking losses, he stepped away, right? So if you want to, go ahead and take a screenshot of this, Control Alt print screen, and drop it into a Word document or notes or whatever, but print them out. Because this will help you not only identify patterns in the market, it'll help you identify patterns in yourself. All right, this is another big one. Don't know when to take the money or know when to pause. So right, let's say you start capital, and it doesn't matter. This 10,000 is just a round number. Say it's 1,000, say it's 500, say it's 5,000. When do you take some money out? When do you scale up? When do you stop trading and reevaluate? I'm going to use 10,000 just as an example. So, right, let's say you start with $10,000. One of the biggest mistakes people make is they never take money when they're making money. So let's say you have starting capital. This should be in your trading plan, by the way. Let's say you start with $10,000. You may in your plan say, you know what? If it gets up to $14,000, I'm going to take $2,000 out. That's going to be mine. I'm going to put it towards whatever. Maybe it just goes into a savings account, saving for whatever your goal was, your big goal. And by the way, I encourage people, you can have multiple goals in your trading plan, right? You can have those giant goals, the I'm going to accomplish and take on the world type goals. And you can have intermediate goals as steps to get there. So starting capital of $10,000, if it gets up to 14, you might want to take 2,000 out, make it real. Then have the next level. Hey, you're now at 12,000. When you get up to 16,000, maybe you say, hey, I'm going to take 2,500 out, and then I'm going to try to continue to grow the rest, right? You continue to make it real. If you don't take money out, it will eventually be gone, right? At some point. So you need to know when to remove money. Now, at some point, you may want to scale up as well, right? So you might have it in there where, okay, you took money out at 14,000, went to 12,000. If it gets to 15,000, you're not going to take money out yet, but you're going to trade one more contract than what you would typically trade. So instead of say you were trading 2 contracts at that point, now you want to trade 3. And then if you get your account up to 18,000, maybe you take 2,500 out, continue to grow and trade 3. And if it gets to 20,000, then you trade 4 contracts. One thing I'd say about scaling up in contract size, never do multiples, always do it in order, meaning if you're trading 2, go to 3, then 4, then 5, then 6. Don't go 2, 4, 8. That's a huge mistake people make. The risk elevates way too quick. So understand that. On the other side, you need to know when you stop trading and reevaluate. Like for instance, this guy that I just gave you the example. Oh, by the way, I forgot to mention. Yeah, after 2 years of trading, he finally went into his boss and was able to give his notice, and now he's a full-time futures trader. And he credits us all to tracking the trades. Don't know if I'd mentioned that. One of the great things he did was he had been making money, and I forget what the numbers were. We'll say it was $16,000. He made $16,000, and all of a sudden he started taking losses. Excuse me. So when he got back down to about $12,000, yeah, he had said he lost about a quarter of his account from the high point, so it was down about $12,000. He stopped trading. That's when he stopped trading and reevaluated. Now, if he had never made money, let's say like a lot of us, we start out and we don't necessarily make money at first, but we have $10,000, have a point where you're going to stop trading and reevaluate what you're doing, right? So maybe that's, hey, if you lose 20% of your account, maybe your account drops to $8,000, walk away. A good friend of mine who owned a brokerage firm, a very successful brokerage firm for a long time, great options trader, great trader in general. He ran a study and he actually showed me, and I've seen it, I've never done the full stats on it, but when somebody loses 50% of their account, even if it takes 2 days or 2 weeks or 2 months, there's a magic level there when they lose 50% of their account, almost invariably, they will lose the rest of the money within a matter of a couple of days if they don't walk away. It's like a psychological threshold. And he showed me all these studies of all the people, and you could literally watch them blow up when they got to that 50% level. It was absolutely fascinating. So have a level. Losses are part of it. Have a level that you understand ahead of time, right? This should be in your plan that hey, I'm just going to stop trading. I'm going to walk away. I'm going to do some study. This is where it's going to be important to track your trades as you're doing it. So start doing it today, because otherwise, what are you going to reevaluate? You're not going to have anything to go off of. Memory is not very reliable. So have those trades tracked. Start doing it for the very next trade you place. Start keeping it. Even if you don't have your printer yet and your 3-hole punch in your paper, at least start keeping a file of them in there, and it'll do values. But you need to be able to reevaluate your pattern. So at X, I do X, right? All right. Well, sorry, I've been talking a lot. Hopefully, you got some benefit out of some of these pitfalls. By the way, I will say these are the most common. There are clearly a lot of ways people can invent to lose money. I've done everything in here. I've done it wrong. I've learned from it. Still learning. Great thing about trading is it is a lifelong experience. So happy to take any questions. Oh yeah, the webinar that I did a couple weeks ago, give me 1 second. I will try to find it. The one where I talk about my methodology, right? It is on, if you go to nadex.com, and give me one moment here. Underneath Learning Center, then resources, you'll see webinars. If you go to webinars, you can see the upcoming or the on-demand. If you click on demand, you will see from March 20th, 2020, analyzing current markets using the platform. So that's the one where I talk about like a strategy I've used. Again, it's not exhaustive. What it will do though is give you maybe some ideas on ways to look at the market. And then I don't ever believe in giving anybody the answer. I'll just tell you where to search. It's up to everybody else to do their own work. The only people that are successful are the people that put in the work themselves. It makes it a bit of a process, but you'll never learn otherwise, right? Well, awesome. Actually, I see that we've already run pretty much overtime, but yeah, if you want to check out that webinar, it's in the hey, Tom, you know what? The question is suggesting a way to consistently profit really at any interval. I can't. What would work for me or for anybody else isn't going to work for everybody else. I'll give an example of that. One, you should study this webinar. I'll have the recording available. Sometimes, like for instance, trading trading is a very personal experience. I'll give you an example here. I used to when I was trading coach, there were two of us, and we sat right around the corner from each other. We traded exactly the same patterns, exactly the same strategies. He was extremely short term, so I was a short term intraday trader. I was typically in trades for something like 20 minutes to 2 hours. That was like a normal trade for me. He was in trades. He was a true scalper. He was in trades for like 2 minutes. We were using the same method. He was just doing it on a very short time frame. So we decided for a week, I would trade his time frame, he would trade mine. We both ended up losing money because it wasn't right. So nobody can actually ever suggest a way to be, I mean, they can give guideposts, but to be consistently profitable, you have to put in the work. That's all there is to it. What I'd suggest is for any time frame you're trading, again, track your trades. Go back, take the screenshots, figure out how you're analyzing the decisions, right? You're never going to be 100%, but it's always about putting in that work. And let's see. Oh, as far as implementing stops, yeah, that is in the roadmap. I don't have a set time frame on that, Paul, but yeah, I mean that is in the roadmap. We've had a few other things that we've had to put into development ahead of that cycle, and it did turn into be a good chunk of work, but that still is on the roadmap. Unfortunately, don't have a great answer for you on that. And follow up to anytime soon. It won't be in the next 30 days, I'm guessing. But let me check on that. I should be able to get an answer. I can't remember if it was towards if we got in towards like the end of May or June, or if it was pushed out. But it was a good bit of work, and so I think our original plan was to have them at least in demo by now, but that kind of got pushed back. Unfortunately, as a lot of technical items tend to do once you kind of get under the hood and start digging in. One thing that we don't want to do is ever release something that we haven't fully vetted and tested. But yeah, I think everybody's pretty excited about that development, particularly on the brackets, right? Because of the range, and because if the market moves in your favor, you want to be able to put a stop behind them. So, Paul, I'll answer it like this. I'm not going to read the question out loud because of non-disclosures, but yes, there's a longer term goal of that, and we have a big project where we're looking at connecting with a lot of various partners. I think Nadex as an exchange is great. I think that we lack in a lot of tools. We continue to try to improve, but quite honestly, as a technical trader, I think there's a lot of tools. There's a lot of systems I've used and things that I like. So we're going to be looking to partner. It was still within the 2020 timeframe. So we're looking to bring on board these partners now. Um, as a lot of people can guess, a lot of our projects, particularly when we're dealing with third parties and they're dealing with us, the last month or so, they've kind of been derailed a little bit as everybody's been scrambling to work from home, get systems set up, make sure all their systems are functioning. But yeah, we're looking, I think everything's kind of, not as far as the market's concerned, but as far as I think everybody's um, roles and tasks, they're really settling down at this point. So yeah, we're looking at a lot of third parties to do different types of relationships with that can offer tools to our traders and still execute Nadex trades. All right. Well, I think I got all the questions. I want to thank everybody for joining me today. Hopefully, there was some useful information, and just want to send best wishes. Hope everybody stays safe, stays healthy, and look forward to seeing you on the next one.